Not too many things this week, so this week will be slightly shorter.
Not many, but very important signals for the market.
Powell is at it again, causing turbulences Wednesday after FOMO meeting.
Let's talk about that and give our key market outlook.
And as always, hit that subscribe button if you haven't done so already. And let's get the show on the road. On Wednesday, Powell's presser basically confirmed that the Fed is going to start changing direction for the monetary policy.
Yep, later we will talk about what he says specifically on topics of inflation, employment, reducing bond purchases, and interest rate hike.
Before, Powell had said that inflation is temporary and within control. But now, he said inflation is higher than he thought and could last longer.
But also, he said that the cause that was driving the unusual high inflation in the past 2 months are still only temporary.
So I'm confused. He said inflation is higher than he anticipated and could last longer, possibly. Why is he saying the recent highs are still temporary?
The main cause driven up the CPI is high demand and not enough supply. This will not rebalance in a month or even two.
Okay, I guess. But how is the 5% high inflation still only going to be temporary? Is it because in the longer term, the supply chain will sort itself out?
Yes, that's what Powell meant. And in the short term, the market should get comfortable seeing consistent inflation above 2%, will be higher than their inflation projections.
So if the supply chain rebalances itself out, can we expect the pricing of the goods and services to come back down immediately?
Not immediately. Probably it will take around 3 to 5 months to reflect on the market. But Powell did mention they are expecting the supply chain and production across a range of industry to improve in the next couple of months. This essentially will flatten out, lower the inflation rate a bit.
Ah, that's why Powell said their forecast may have been wrong from earlier. So basically he's vaccinating the market. So when we keep seeing a 3%, 4% inflation, the market won't react as aggressively.
Exactly. He's giving us a heads up and act accordingly.
And here's something that's even more confusing. He also said everyone misunderstood how the Fed calculates their 2% inflation projection, right, over a period. But then he didn't really explain how he calculates it. Sometimes 1 plus 1 doesn't equal to 2. And the current inflation has nothing to do with the inflation projection. Like, what the fuck is he saying? Is it me or is he not making any sense?
Well, the way that I understand inflation is very simple. Raw material cost is going up, not enough productions to keep up with the demand, and no one is even working. Do you know what is more obvious? McDonald's increased their prices for the first time.
Well, I also heard Chipotle also raised prices, but they said not because of raw materials or the supply, but to be able to increase wages for their workers.
Powell also said that the inflation projection is not the reason for the recent unusual high inflation. The problem is being able to distinguish special causes from general cost of goods increase.
No shit, that was real helpful. Point is, if inflation keep rising uncontrollably, the Fed will make certain changes to the money policy.
Yep, anyway, there are basically two considerations for the Fed on reducing bond purchasings and rate hikes, and those are inflation and employment.
So speaking of employment, what did JP say about that?
That we should be expecting a lower unemployment rate, but how can unemployment go down if many companies are not operating at their full capacity due to supply shortages? You don't need as many workers as before.
Oh, so the supply chain disruption is actually preventing companies from operating at full capacity. Basically, think of it like this. You have 5 people who can make 1 CPU each, but now you only have material enough for 2 CPUs. We're not going to hire all 5 people for now, right?
Yeah, so eventually we gotta need those workers back as we have recovered more. The demand for labor will go back up.
But we don't know when and how much unemployment we can recover.
Exactly, so we kind of need to be patient now.
And we might be expecting more open jobs in the next couple of quarters as Biden's infrastructure plan rolls out.
So there will be jobs. Now the big question is, are they going to work?
I think so. As the unemployment benefits go belly up, what are they going to feed their family with, right?
True. So as we have inflation number under control and employment data meeting expectation, it is time to consider cutting back on some bond purchasing.
If the Fed expects to raise interest by 2023, reduced bond purchasing might happen anytime from now before rate hikes.
Mm, how do you know that for sure?
Well, I mean, simply the Fed isn't going to borrow money to buy bonds on a higher interest rate. Like they could buy $1 worth of bonds using $1, but if they raise interest rates, now they're going to be paying $1.15 for the same amount of bonds.
I see. Good news though. The Fed will hold on discussing reducing the bond purchases until getting more economic data.
Yep, Powell said something new this time, which is if inflation is still out of control, and like we mentioned in previous weeks, that if the employment is balancing out between the blue and white collar, then the Fed will start scheduling bond purchases tapering.
So when you say out of control, do you mean above 2%?
All right, but remember, Powell said that we are interpreting the 2% projection wrong. So it's anybody's guess for now until we get new projection from the Fed.
That's right. And the key takeaway is that Powell will let the market know ahead of time so the market can be prepared and digest it slowly.
And plenty of time ahead, might I add. So I believe just keep the tapering in mind when making your purchases, and you should be fine.
And finally, rate hikes.
The important takeaway is that rate hikes will happen after tapering on monthly bond purchases.
So previously, the market is expecting the earliest rate hikes will be in 2024, but that has changed after this meeting.
According to the latest dot plot, 13 out of 18 board members forecasted at least one rate hikes before the end of 2023, and total of 11 board members forecasted at least two rate hikes before the end of 2023.
So can you elaborate more? How do we read the dot plot again?
All right. So looking at 2023 under this column, these are the five people who maintains under 0.25, basically no hikes. Then these are the 13 people who predicted at least one rate hikes because now the rates are over 0.25.
What about those who guess at least two hikes?
So this is the two hike group, everyone above 0.5. Since each rate hike is limited to 0.25, so anything above 0.5 means that they're forecasting at least two rate hikes.
By that logic, then I can't ignore the 2022 rate hikes. Check it out. 7 people think we will have at least one hike in 2022.
Yeah, I didn't see that, but you're right. And during next meeting, we might see more than 7 out of 18 members vote to hike rates in 2022.
Definitely need to keep watching this. Things might change in the future.
Good call. Anyway, back to rate hikes, right? Powell stressed that they haven't discussed which specific year is appropriate.
And also, the dots can be used as a good forecaster of the future rate changes. Take it with a big grain of salt. At least that's what JP said.
Who would believe that? In my opinion, he just wants to calm the market.
This is like watching a trailer of a new movie that is coming out. You kind of know what is going to happen, but not the details.
Regardless, I believe the main takeaway is the FOMC meeting has turned hawkish, and we need to also change our investing approach a little bit.
Agree. If buying property is all about location, trading is all about adaptations.
So we would like to suggest a few things to keep in mind.
First, we need to know that tapering is coming, so we need to stick to the plan.
And that means no chasing high valuation stocks anymore. That worked in the printer market, but won't work in the taper market. Anything that's 15 to 20% above valuation, buy with extreme caution.
Yep. We need to assume the Fed will announce tapering every meeting from now on and be ready for 15% pullbacks on any specific stocks, especially those overvalued ones.
Yeah, and now that JP has told us, hey, we're thinking about this. He's basically telling us that, every meeting from now on, like he said, we need to expect the unexpected. And secondly, as the economic data coming out, you'll see shares pull back 15%. That's very normal. And we're talking about individual stocks here.
So, common question we get is most stocks are overvalued. Will market crash? Our opinion, and you can correct me if I'm wrong, the S&P can totally pull back 10 to 15%, no problem. And you will basically correct the stock price to average valuations. So the important thing is to mentally accept that fact now rather than later.
Yep. Market won't keep going up all the time at the end of the day. I mean, if that's the case, then it would be an ATM, not the market.
Third, if the market really pulls back 10 to 15% as the tapering and rates start going up, which is a result of economic recovery, companies with consistent profitability is a green light to buy. No need to worry.
Remember, keyword is profitability. But nonetheless, when buying consistent companies, the pullback will bring the average valuation down. No companies will be able to escape that. So, in that case, how would you deal with that?
I would deal with it through not going all in. Have a position buying plan and manage my cost basis. I'm not worried about dipping, only that market drags it down too much.
Fourth is on growth stocks. We have 3 sub approach. First one is you can do technical swing plays if you're good and have time to read the charts.
Second is fundamental catalyst play. These 2 will work, but they are tough to catch. Now the third one is much easier. You can pick an industry that you love and believe in and use small size to bet on it, like EVs or AI. Treat this investment like a VC and be ready to risk it all.
Yeah, I agree. And that's what I'm doing with Bark. I have a tiny position, and I am ready to risk it all.
Now, the fifth and the last thing to keep in mind, we can't keep expecting weak dollars. As we can see from Wednesday, the commodities took a hit. They were going ham because of weak dollars. The bond tapering and rate hikes in the next 2 years will be a good support for the dollar.
In other words, we can't expect commodities to keep popping off. It might slowly go up, but just not aggressively going up.
Right, so that includes all the commodity companies. If you are playing those, you can't ignore their fundamentals and valuations. So it's probably better if you don't chase any commodity if they are already up a lot.
That's about wrap up our opinion and main thoughts on the week. And be sure to check back in next week because we will be giving out our rate hike stocks with detailed entries and levels.
Yep, and those will be our main watch and setups for the tapering and rate hike period.
All major indices dropped on Wednesday after Powell opened his mouth. Russell Small Cap being the worst performer, closing the week with slightly more than 4% in the red. And Dow Jones had a worst week since October last year, dropping about 3.5%.
Nasdaq and S&P rebounded quickly on Wednesday's dip, and Nasdaq were able to close the week green, versus the S&P down a little over 2%.
Dow Jones gapped below critical support at around 33,550 and confirmed the M-top formation. This is not looking too good, and we could see testing a lower support at around 32,000.
So that's about another 5% pullback. Looking at Nasdaq after the bounce, we actually make a new high this week. If tech get pulled back with the Dow Jones, I don't expect a drop as much as 5%, but likely to test the support area around 13,800.
And the S&P closed right on the trend line and left everyone guessing for the weekend. 2 near-term support I would like to point out are 4,130 and 4,050.
Russell dropped back down to the trading box range we mentioned before and confirmed the recent breakout is a false breakout or a bull trap.
Russell is going back to play some ping pong again. The dollar is looking strong and finally having a run now due to the recent announcement from the Fed.
Thank you for watching. If you find this video helpful, feel free to give us a like and subscribe for more content like this.